I want to start today with a contradiction, something that honestly I found genuinely confusing while we were prepping for this deep dive.
Oh, yeah.
Yeah, we're always told by every finance textbook, every market guru out there, that to get massive market-beating returns, you have to take on massive risks.
Right. The conventional wisdom, high risk, high reward.
Exactly. If you want 40% a year, you're supposed to bet on the volatile stuff, the moonshots.
Yeah.
The companies that could go to zero just as easily as they go to the moon.
Sure, that's the trade-off.
But then I look at the data for the company we're covering today. And here's this company that is, by all accounts, an established heavyweight. It's not a startup. It's not a meme stock.
It's not some crypto token with a dog on it?
Not at all. And yet, looking at the numbers from our source, it has been quietly crushing almost every darling of the tech world for a decade. It feels like a glitch in the matrix.
It does look like an anomaly, doesn't it? If you look at, say, the last 10 years, Broadcom has delivered roughly 39% average yearly returns.
39%.
And even if you zoom out to 15 years, it holds at around 38%.
Which is just unheard of for a company of this size. I mean, I actually double-check these stats because usually when I see a line chart going up that smoothly for that long, I assume I'm looking at a Ponzi scheme or a typo.
Well, fortunately, it's neither.
So what is it?
What you're seeing is the difference between what I'd call hype growth and quality growth. Hype growth is jagged. It shoots up 200% when a narrative like, say, the metaverse or AI is trending.
And then it crashes 60% when interest rates go up or the hype cycle moves on.
Exactly. Broadcom is different. It's what our source here describes as a quiet compounder.
Quiet is definitely the operative word. And that's what gets me. Why isn't this on the magazine covers? We see NVIDIA everywhere. We see Microsoft. We see Tesla. Broadcom just feels separate.
Well, I think a huge part of it is that they aren't consumer-facing.
You think that's all it is?
Broadcom is the plumbing of the internet. You don't really look at the pipes in your house and marvel at them. You probably don't even know who manufactured them.
No, of course not.
But if they burst or if they clog, your whole house becomes unlivable. Broadcom builds the infrastructure that lets all the flashy apps work. They aren't building the chatbot you talk to. They're building the massive data highways that the chatbot lives on.
So our mission today is to tear up the floorboards and actually look at those pipes. We need to figure out how they're capitalizing on this AI infrastructure boom and, maybe more importantly, if this run is sustainable or if we're looking at the top of the curve.
Yeah, because the source material positions this not just as a tech story, but as a wealth-building story.
It really is.
And I think the best place to start isn't the technology itself, not yet, but the result of that technology. We need to unpack that performance paradox you mentioned at the top.
All right, let's get into the numbers. The source breaks down the returns over these different time horizons, and they're strikingly robust. Over the past 3 years, Broadcom is up nearly 78%.
Which is just, beating the market handily.
Right. But usually a stock that hot cools off. But over 5 years, it's up about 48% annually. Over 10 years, 39%. It doesn't slow down.
See, that is where it gets really fascinating for me. What stands out isn't just the height of the returns, though obviously 40% is fantastic. It's the consistency.
Right.
Usually in the semiconductor space, which is historically super cyclical, you have these boom and bust years. You have years where inventory piles up and the stock just gets hammered.
Yeah, we've seen that with other chip makers. They lose 50% of their value in a bad cycle.
Exactly. But Broadcom's data shows this really rare combination of high performance and stability.
Yeah.
Whether you bought in 3 years ago, 5 years ago, or 15 years ago, you're winning.
And the source makes a key point that it hasn't reached the extreme valuation levels of other AI favorites.
Meaning it isn't trading at 100 times earnings.
Not even close.
Which suggests that the market still kind of views them as a boring dividend stock rather than a high-growth AI play, even though the returns say otherwise.
Okay, so let's talk about why they're growing this fast. The source ties this directly to the explosive expansion of data centers. I feel like data center is a buzzword we hear all the time, but maybe we don't appreciate the sheer physical scale of what that really means.
We really don't. We hear cloud and we think of something, fluffy and invisible.
And ethereal.
But the cloud is concrete and steel and copper and silicon. And right now we are in the middle of the biggest build out of computing infrastructure in human history.
The numbers in the source from S&S Insider they're honestly staggering. They estimate the global data center GPU market was worth about $24 billion in 2024.
Okay.
But by 2032, they're projecting it to reach over $200 billion.
Wow. Think about that. That's almost a 10x increase in less than a decade. That represents an annual growth rate of, what, above 30%?
Above 30% every year.
And here's the context for you listening. If the market for the chips inside data centers is growing at 30% a year, the companies that design and manufacture those chips are surfing a tsunami.
You don't even have to be the best surfer.
You just have to be on the wave. But it turns out Broadcom happens to be a very, very good surfer.
Okay, but this is where I want to push back a little bit. When people think of AI chips, they think GPUs. They think NVIDIA. Broadcom isn't really a GPU company in the same way.
That's true.
The source mentions something very specific, ASICs. I want to get into the specific machinery driving these numbers. Why does that distinction matter so much in this $200 billion boom?
It's a great question, and it's really the crux of the whole investment thesis. To understand the value of an ASIC, you have to understand the pain point of a modern data center.
Which is,
These places are consuming electricity at a rate that is, frankly, terrifying for the CFOs of Google or Amazon or Meta.
it's the energy bill. I've read that power consumption is becoming the #1 bottleneck for AI.
It is. Now, if you buy a general-purpose chip, think of it like a Swiss Army knife. It's designed to do everything pretty well. Can
Yeah.
run a spreadsheet, play a video game, render a movie, whatever.
Okay.
But because it includes the hardware to do everything, it's not optimized for anything specific. It has silicon real estate just sitting there using power, but doing nothing relevant to the task at hand.
So it's inefficient. And when you're running 1 million of them, that inefficiency costs billions.
Precisely. Now, enter the ASIC. This is the bespoke suit tailored by a master.
The source used that analogy.
And it's perfect. Broadcom sits down with a customer, let's say it's Google, and says, what is the one thing this chip needs to do? If it's strictly for managing machine learning traffic, they strip out the video game logic.
Right.
They strip out the spreadsheet logic. They build a chip that does one thing perfectly.
Which means it runs faster and cooler.
Much, much cooler and much cheaper to operate in the long run. Broadcom is the master tailor for the hyperscalers, the tech giants.
And this isn't just theory, right? We can see it in the profit and loss statement. I was looking at the financials provided for fiscal year 2025. Broadcom reported revenue growth of 24%.
Which is strong.
Very strong. But here's the kicker. Their net income jumped 42%.
And that is the number that should make you sit up and take notice.
Why that one specifically? The gap between revenue and income.
Because when net income grows almost twice as fast as revenue, it tells you the company is becoming incredibly efficient. It means their margins are expanding, they have pricing power. For every extra dollar they bring in, they're keeping a much larger chunk of it as profit.
So they aren't fighting a price war. If they were selling a commodity, their margins would be getting squeezed, not expanding.
Exactly. Because there are very few tailors in the world who can cut a suit this complex. This isn't something a startup can just replicate in a garage. We're talking about highly protected intellectual property engineering teams that have been working together for decades.
So they have a moat?
A very wide one. And that moat is filled with cash, which I think leads us to the most actionable part of this deep dive for anyone listening.
The strategy.
The strategy.
Yeah.
Because having a great company is one thing, but knowing how to use it to build wealth is another. The source has this section on the power of long-term compounding. And honestly, usually when I see these charts, I roll my eyes a bit.
I know what you mean. If you saved $5 a day since the Roman Empire, charts.
Right. Just stop drinking coffee and you'll be a billionaire. But
Yeah.
this is different. This uses a scenario based on realistic high-growth investing.
Okay, let's walk through the math they provide.
Hmm.
They lay out a scenario A. Let's say you have a $1,000 investment, just a one-time thing.
Okay.
And let's say it grows at 25% per year.
Which, to be fair, is lower than Broadcom's recent historical average of 40%. But it's a good, aggressive baseline for a high-growth stock.
A reasonable assumption for the exercise. So you put that $1,000 in, you don't touch it. After 10 years, that single grand turns into more than $9,000.
A 9x return. Not bad at all.
But the magic really happens in that second decade.
Always does.
If you leave it alone for 20 years, that $1,000 becomes close to $87,000.
And that's the hockey stick curve of compounding.
Yeah.
But the source takes it a step further with scenario B, and this is where the discipline comes in.
Right. Scenario B assumes you invest $1,000 every single year.
Which is roughly $80 a month. I mean,
Yeah.
that's a very doable number for many people listening.
For sure. So you invest $1,000 every year into something growing at 25% over 2 decades. You haven't just made 87 grand. That portfolio would be worth well over $300,000.
Over 300,000
Hmm.
from putting in what amounts to, a nice dinner out once a month.
It really highlights that the quiet strength isn't just about the stock. It's about the investor's behavior. But let's play devil's advocate here.
What's
That math all relies on the 25% growth continuing. And that's a big assumption. The source says Broadcom is trading at a forward price to earnings ratio, a PE of near 34 right now. For a hardware company, historically, that's expensive. Are we paying a hype tax now?
That's the critical risk check. And you're right, a PE of 34 is certainly not bargain basement deep value. If this were a utility company or a grocery chain, I'd tell you to run for the hills.
Even for a legacy tech company, it's pretty high.
True, but you have to look at the denominator, the earnings growth. The source calls the valuation not excessive for a reason. Broadcom is growing net income at 40% plus.
Okay.
If you have a company that's doubling its profits every 2 years, a 34 multiple unwinds very, very quickly. You're paying up for the growth velocity.
The classic growth at a reasonable price idea.
Exactly.
Right.
And compared to some other AI favorites, some are trading at 50, 60, even 100 times earnings 34 looks downright reasonable. But there's another factor that I think makes this valuation safer than it looks.
The dividend.
The dividend. This is so rare in high-growth tech. Usually, companies growing this fast pour every single penny back into R&D. They don't pay you,
And Broadcom pays a yield of around 0.8%.
which might sound small, if you compare it to a bank stock.
Mm-hmm.
But in the context of a company growing 40% a year, it's hugely significant. It means they're generating so much cash flow that they can fund their massive R&D, acquire other companies, and still have enough left over to write a check to shareholders.
And the source notes they have a history of raising that payout over time.
And that's the key. That dividend acts as a psychological anchor. When the market dips, and it will, tech is volatile, that dividend check hits your account and you think, okay, I'm still getting paid.
It keeps you from panic selling.
It keeps you in the trade so you can actually achieve that 20-year compounding result we were just talking about. It's not just about picking the stock. It's about having the stomach to hold it. And Broadcom's dividend helps give you the stomach.
That's a really interesting way to look at it. It's a hybrid vehicle. It's got the engine of a growth stock, but the safety belt of a dividend bidder.
And in a market that is obsessed with the next big thing, having that safety belt is what lets you sleep at night while still capturing the upside of the AI boom.
I want to circle back to that quiet aspect one more time before we wrap up. The source mentions their strategy being smart and disciplined. It almost feels like they are intentionally avoiding the limelight.
I think they are. You see, when you're a consumer brand, like an Apple or a Tesla, you have to constantly wow the public. You need the keynote speeches, the flashy product reveals.
All the marketing.
All of it. Broadcom's customers are the smartest engineers at Google and Amazon. They don't care about the flash. They care about the specs.
They care about the tailored suit.
They care that the chip works, saves them power, and arrives on time. Broadcom's discipline is in ignoring that consumer hype cycle and focusing entirely on the engineering relationship. That's why they're so sticky. Once you design your whole data center around Broadcom's custom chips, you can't just switch to a competitor next week.
You're locked in.
You're locked in.
So, okay, pulling this all together, we have a company that is surfing a $200 billion tsunami in data center spending. They hold the patent, essentially, on the custom suits that the biggest companies in the world are forced to buy to keep their energy bills down.
That's right.
And despite a PE that looks a little high on the surface, the compounding math and the dividend history suggest this is a long-term hold, not a quick trade.
I think that's the perfect summary. It's a reminder that boring infrastructure often outperforms exciting consumer tech over the long haul.
It's the classic picks and shovels story, just with a lot more silicon.
And much better margins.
And much better margins. It definitely makes you rethink the strategy of chasing the latest IPO. We're always looking for the next revolution, scrolling through news feeds, trying to find the thing that's going to change the world. But based on what we've looked at today with Broadcom, maybe the most rewarding strategy isn't finding the shiny new toy.
Perhaps it's simply finding the company that quietly builds the infrastructure that makes that next big thing possible in the first place.
It really begs the question, is boring the new exciting?
It just might be.
Thanks for diving in with us and walking us through the plumbing of the AI revolution.
My pleasure. Hopefully it helps everyone see the pipes a little more clearly.
That does it for this deep dive. We'll catch you on the next one.